We recently did a podcast on recency bias for investors, and that happens to occur in more than just the stock market. If we go back the last decade, we found real estate prices were rising until the summer of '07, but the assumption was real estate always goes up. In fact, that's the mantra that the real estate broker has. Just go ahead, don't worry about the price because real estate always goes up. But of course, that relies upon you having a long-term tendency in your real estate, and as with the stock market, that you are a long-term investor. Well, our bias about real estate is that real estate goes up. But what we're finding as a result of the high interest rates is that market prices and supply are changing, and they aren't inside that higher is better range of numbers. My name is Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
So one of the things that's been hurting real estate is the lack of transactions. Without transactions for price comparison, it's pretty difficult to figure out what your property is still worth. And in major metro areas around the country, supply is increasing, prices are falling. Mortgage rates, however, are not. They're pretty stable in the mid 6% range, which
Right.
In a long-term perspective is an average interest rate paid by even the boomers. And the boomers didn't get any deal on financing their homes.
Right.
In fact, one of my clients paid 21% for a 30-year mortgage. Back in the
People
early
can't even
80s.
imagine that now. Yeah, what they paid? What It's like that was a real loan from a real bank. And that's what it was. That was a going rate.
I know those didn't last long. Paul Volcker stepped into the financial markets. He started bringing rate. He actually raised rates to kill inflation, and rates started to fall. But right now, what we have going on is an increase in supply. People are moving out of major metro areas, so that's partly increasing the supply. More people are getting discouraged about having to wait so long to sell their property, so they're putting them on the market and saying, I just got to get out of here. I don't like the area that I'm in. Maybe it's a crime issue, maybe it's a drug issue, maybe it's a job issue, maybe it's I got to move to take care of parents issue. There's lots of reasons people move their location. But They're finally saying, I got to go. I can't do this anymore. And as that inventory increases, price competition increases. And that means that the sales that are beginning to occur are happening at lower prices. Now, they're not falling out of bed.
Correct.
This isn't 2008 where we all of a sudden realize there's a whole bunch of mortgage fraud going on.
Big trouble. Yeah. But it is. If you're a homeowner, it is making people pause and say, maybe we don't want to list right now. Maybe we don't want to sell right now. The prices are trending down, and that means there's something wrong. Because, like you said, Don, real estate prices always go up, right? So if prices are going down, something's very wrong here, and this is probably a market we need to avoid, if possible. Sometimes people just can't. But prices going down doesn't necessarily mean there's anything wrong. It just means the market shifted, and that happens all the time. And you need to deal with the market as it is, not the way you wish it was. And that's so important to be able to look at a market and say, well, I have to sell right now, so I'm just going to do the best I can. These are the market prices, so that's what I'm looking at. And if you don't have to, you can wait. You can wait on that, and that's one of the forces inside of real estate right now is that people are waiting. They're like, hey, wait a minute, rates are still kind of high. I don't want to go somewhere else and dump my 3% mortgage to go get a 6% loan. I don't want to do that. Plus, I'm going to get a little bit less for my house right now. To me, that says, if I have the option, I'm going to wait. I'm going to wait a little while, and that doesn't help the market right now.
Well, with mortgage rates where they are, that's a different factor, which is a little more difficult to deal with. You can't control that. On the pricing factor, there is an offset. If I sell my house for less, the odds are, depending on where I move, I'm going to buy a house for less than it was listed or appraised for a year or two ago.
Sure.
So from an equity standpoint, that can be a trade-off. The mortgage issue coming out of a 3.5 to go to a 6.5, that's a cash flow item, and that may not be comfortable enough to actually make a justification in the move.
Right.
So,
Right.
so that's a serious problem. But there's another way to deal with this, which is becoming more common. In fact, there was an article recently written in Seattle about an individual. The man who wrote the article was writing about his family. They bought a house that was basically a fixer-upper. They knew it was a fixer-upper. It was really old, but he moved into an area that had an HOA, and he had to have the approval of the HOA members that he wasn't going to destroy their view. They approved the architecture, they approved his floor plan, his footprint, all sorts of things. He went through 2 years and 13 sets of plans to finally have somebody who was not impacted by the view at all
Uh,
put up an objection, which killed the entire deal. And living there 2 years in a house suffering with poor insulation, windows that actually froze over during the winter. That's a tough job.
that's not good. Yeah.
But
That's
they
not
had a lot
good.
of hope. But their recency
Uh,
bias was things, real estate, things would go up. We're going to fix up the property and this is going to work out okay. As it is, they managed to sell it after 2 years and basically break even, he said. And what did he do? He moved 2 houses away into a much more modern facility with as good a view, heat that worked,
there we
no
go.
ice on the windows, and it's a rental. And he said, but what's happened is he's basically put the money that freed up from real estate into the stock market, and he made 7% a year, which is more than he would have made if he'd actually owned the house. The house prices didn't appreciate that much.
Right.
So it was a function of saying to himself and his spouse, this time is different. This is not the same real estate market that we are used to or that our parents had. The market's better. Maybe it's time to do things differently. So he walked away from the hindsight bias issue and made a reasoned decision about how the market is really working, both as far as real estate and equities are concerned.
Right.
While that may be a difficult decision emotionally, it's a rational one that actually has a better outcome for his family. And he has less stress. If he has a big problem with real estate, he has somebody to call and say, you have a problem. You got to come fix my whatever the issue is.
There you go. And it's so important for people to stop and look at the market honestly and forget about whatever the narrative is that's floating around. If any of you were investing back in the 2000s with the tech bubble and how the internet has fundamentally changed the way the world works, and the stock market is never going to go down again. We have got productivity straight to the sky now. Nothing's ever going to go backwards. Everything's going to go up. Just buy, buy, buy. And then the tech bubble busted and people did not understand what was going on. In fact, they didn't even believe what was happening. The first big down leg was, well, just buy all you can. This is a huge mistake by the people that are selling. Just grab all these large cap tech companies because we're going straight back up from here. And of course, nope, it kept going down. But you had to look at what was actually going on and dismiss the narrative. Right now, real estate's been so strong. It's like, well, then if we buy real estate, there's almost no risk. We're going to make money. It's going to go up. Everything's going to be great. And by the way, my house was worth $1 million last year. Next year, it's going to be worth 2. Well, that's not the way it's going. And it's important to look at what is instead of what was, because what was doesn't matter much anymore. Markets change very quickly, and the change is large enough that you have to dismiss what came just last year. It doesn't matter. What's going on right now? That's what you need to deal with. That's true in real estate. That's true in any market. You need to pay attention to what's going on currently and make adjustments in your portfolio based on market conditions, not on historical averages or what markets have done before. What they've done before, really almost no concern.
Well, you mentioned market averages. That's really important because most people and most financial advisors in building a portfolio, look at the last 40, 50 years. In some cases, the models are built off data since 1929.
Right.
Well, that data and those markets have nothing to do with what's going on today. The time
Right.
period for looking back over what is happening should be shortened significantly, because that's all that matters is what is today's economy. If you go back to the 20s, actually, if you go back to the late 1890s, we had a stock market back then, but it was railroads. In the
Correct.
20s, we're looking at automobiles. Well, and then we got up into out of the depression, it was defense because we're building for the war. And post World War II, we end up with housing coming back into the market because of the baby boom that came in. And that put pressure on the need for schools and teachers. And that actually is kind of starting up again because the Gen Z is having more babies than was expected. But right now, what you have is you have technology and consumer discretionary. Surprisingly, you have utilities, which is typically a retirement income pension plan kind of asset,
Correct.
in a position of leadership because of data centers and technology. The utility companies that actually can address the power needs, they're growth companies. They're not the old adage, this isn't your grandfather's Buick. from GM.
Right.
And the utility companies have opportunity that we haven't seen ever before. So change your perspective, do some homework, figure out where the money's flowing, because that's where the opportunity is for your portfolio to grow and to achieve your financial goals. That's what we do in our portfolio management, and that's how we guide the 401k plans, where we are the trustee to the we're a fiduciary to the trustees, where we set up and guide and monitor both the investment menu and 5 investment models for employees to use at their option. But it's based on what is going on in the market today. Where are these trends? How are they changing? And what do we need to do to address them so we stay current in the current marketplace?
Correct. The more digital the economy gets, and it's very digital already, the faster those changes take place. And it's much more important to know where are those changes coming from, and then you try to look at where's that going to drive the future of these businesses, and that's where you can watch the cash begin to flow. The money's going to follow those sectors where the productivity is coming from, and it doesn't matter what used to be productive. It only matters what's productive now. And that's why it's so important to dismiss the narrative, follow the money, follow the data, and look at what's successful now. And you can put yourself in a position where the probability is on your side that you're making good trades, instead of looking at what was successful. We don't care what was successful 5 years ago. It really doesn't matter. We're not investing 5 years ago. We're investing today. And that's what you need to track.
The markets are dynamic. Your portfolio should be too. If you're concerned about what's in your portfolio and perhaps you haven't been addressing these issues, you want to talk to us, the contact information is on the screen. Give us a call, send us an email. We don't need to know how much you have, just what you have, and we can do the analysis on that. Subscribe to the podcast. We have more coming, keep you informed, and hopefully continue to educate you. Thanks for being with us today.